Imagine waking up tomorrow and seeing an extra $100,000 in your bank account. The possibilities rush in: pay off debt, buy a house, or maybe invest it all. Now make it $1 million. Suddenly the stakes feel higher and every decision seems more critical. While $1 million sounds life-changing, one wrong move can quietly destroy it. Many people believe that getting money is the hardest part, but in reality, keeping it is even more challenging. Every year, people inherit fortunes, sell businesses, or finally build a nest egg after years of hard work, only to find themselves facing the same dilemma: how to keep it. Strangely enough, many who come into sudden wealth make the same mistake. They think money changes the rules, but the truth is, it doesn't. The fundamentals of managing money remain the same, whether you have a little or a lot. The excitement of newfound wealth can cloud judgment, leading to decisions that might not be in your best interest. It's easy to believe that with more money, you can afford to take bigger risks, but the reality is that the risks can be even greater. Let's imagine two people, Alex and David. Both are 40 years old and both suddenly receive $1 million. Alex sold his business after 15 years of hard work, while David inherited his money from a relative. The amount is the same, but their mindsets couldn't be more different. Alex feels the weight of every dollar. He knows how hard it was to earn. David, on the other hand, feels a sense of freedom and excitement. And while excitement can be motivating, it can also be dangerous when it comes to managing money. Alex immediately feels pressure. This money took years to build and every dollar feels precious. David feels something else entirely: possibility and excitement. He starts dreaming bigger: a luxury condo, individual stocks, maybe even crypto or real estate. He sees this as his chance to become truly wealthy. The contrast is clear. Alex is cautious, while David is eager to take risks. Their different perspectives set the stage for very different outcomes. Within just a month, David's thoughts grow bigger. He considers buying a luxury condo, diving into individual stocks, or even exploring crypto and real estate. He believes this is his opportunity to finally become really rich. Meanwhile, Alex does something that seems boring. He waits. For 30 days, he makes no investments, no big purchases, and no dramatic moves. Sometimes, doing nothing is the smartest move you can make, especially when your emotions are running high. Money has a strange effect on people. When it arrives suddenly, your brain starts whispering, "Do something, anything." But Alex resists this urge. He understands that sometimes the best decision is to wait and let the initial excitement fade. This patience gives him a clearer perspective and helps him avoid impulsive mistakes that could cost him dearly in the long run. After waiting, Alex asks himself three important questions. The first: when do I actually need this money? If he needs it in 2 years for a house, investing aggressively could be a disaster. Markets don't care about your timeline, and a crash won't postpone your mortgage payment. If the timeline is short, cash is safer. If it's long, investing makes more sense. This simple question helps Alex align his decisions with his real needs. Second question: should you invest all at once or little by little? This sparks endless debates. Mathematically, investing everything immediately usually wins because markets tend to rise over time. More time in the market beats trying to time it. But David can't sleep at night imagining his million dropping 20%. He chooses peace of mind and spreads his investments over months. Sometimes, the best choice isn't about numbers, it's about what lets you sleep at night. Third question: how involved do you actually want to be? Many people love the idea of investing, but few enjoy researching stocks at midnight, reading earnings reports, or tracking every market movement. Investing can quietly become another job if you're not careful. Alex realizes he doesn't want another job, he wants freedom. This insight shapes his entire approach to managing his newfound wealth. Instead of trying to become a stock-picking genius, Alex builds something simple. He puts 90% of his money into a low-cost S&P 500 index fund and 10% into short-term government bonds. No predictions, no hype, and no chasing trends. This simple system doesn't require constant attention or emotional decisions. It's designed to be boring, and that's exactly the point. David laughs at Alex's approach. "That's boring," he says. "Maybe it is. But as time goes on, excitement can become a double-edged sword. Over the next 3 years, markets crash, recover, and crash again. Headlines scream panic, and influencers predict disaster every few months. David jumps from tech stocks to AI, from crypto to cash, always chasing the next big thing. David's constant switching means he's always reacting to the latest news and trends. He moves from stocks to cash, back into stocks, and out again. This approach is exhausting and rarely leads to better results. Meanwhile, Alex barely checks his account. His system doesn't need emotions, it only needs time. Slowly, something interesting happens. Alex's wealth grows steadily, while David's results are unpredictable. David spends years trying to outperform the market, always searching for the perfect investment. Alex simply owns the market through his index fund. The secret that few people talk about is that investing isn't about finding the perfect asset. It's about surviving long enough for compounding to do the heavy lifting. Consistency and patience beat constant change and excitement. Most people think building wealth requires extraordinary intelligence. In reality, it usually requires extraordinary patience. Compounding works best when you give it time and avoid unnecessary risks. By sticking to a simple plan and letting time do its work, Alex's wealth grows steadily, while David's frequent changes hold him back. The lesson is clear: patience pays off. 20 years later, Alex and David's outcomes look very different. It's not because one had more money to start with or was smarter. The difference is that Alex built a system and stuck with it, while David kept changing his approach. Over time, the power of a consistent strategy becomes clear, and Alex's simple plan outperforms David's constant adjustments. Alex's success isn't about luck or intelligence, it's about having a system and following it. David's instinct to chase the next big thing leads to stress and inconsistent results. The lesson here is that building wealth isn't about being the smartest person in the room. It's about having the discipline to stick with a plan, even when it feels boring. In the end, money was never the real goal for Alex. What he truly wanted was freedom, the ability to live life on his own terms without constant worry. Freedom rarely comes from complexity. It usually comes from doing simple things consistently for a very long time. Alex's story shows that true wealth is about more than just numbers in a bank account. Complex strategies might sound impressive, but they often lead to stress and mistakes. Simple, consistent actions are easier to maintain and less likely to go wrong. Alex's approach proves that you don't need to be a financial genius to build lasting wealth. You just need a plan you can stick with, year after year. Many people who come into sudden wealth fall into the same traps: chasing trends, making impulsive decisions, or believing they can outsmart the market. The real danger isn't losing money in one bad investment. It's failing to build a system that protects you from your own emotions. Alex's story is a reminder to focus on what you can control and avoid the common pitfalls. True wealth isn't just about having money, it's about having options and peace of mind. Alex's journey shows that the real value of wealth is the freedom it brings. By focusing on simple, consistent actions, you can protect your wealth and enjoy the benefits for years to come. The million-dollar decision isn't about what you buy, it's about how you manage what you have. In the end, the story of Alex and David teaches us a powerful lesson. Getting money is hard, but keeping it is even harder. The key isn't intelligence or luck, it's patience, discipline, and a simple system you can stick with. If you ever find yourself with a windfall, remember, don't let excitement drive your decisions. Build a plan, stay patient, and let time work for you. That's the real million-dollar decision.